Hey traders, welcome to Charts and Coffee. Happy Thursday morning, everyone. Let's kick off today's show with a look at the economic calendar. That coupled with the fact that we are still in the very, very thin part of the summer trading months is, obviously very apparent. If you take a look at the volume that we're seeing day after day, this lowered volume is really only awakened by specific events on the calendar where everyone knows it's time to show up. We're going to get some sort of data, and we'll definitely see a little bit of sporadic attention with unemployment claims, manufacturing PMI, maybe the consumer confidence and existing home sales. And then tomorrow, we've got the Jackson Hole Symposium, Powell speaking tomorrow at 10 a.m. And the Jackson Hole Symposium creates a little bit of volatility and chaos its own because we don't know when different members will be invited to speak on television or what have you. So it's a tricky part of the year. You take that low volume, you take the Jackson Hole Symposium, and things get a little bit more tricky. Now, what about next week? Rag, is this going to persist into next week? Yes and no. Next week, we have a lot more scheduled events. So while we probably will still see midday meandering and maybe a little lethargy in the later part of the morning, core durable goods on Monday, consumer confidence. Right now, the consumers definitely moved up on that importance scale in terms of what's moving the broader averages. Because if the inflation issue right now, for the most part, is, I don't want to say solved, but the Federal Reserve is going to start to cut rates. So at least it's a little bit more in the back burner. Next week, we get PCE, we get GDP, but all of a sudden, those consumer numbers, retail sales, we had the University of Michigan consumer sentiment. Those are going to have a lot more impact because now, since one problem is pretty much addressed, the market is a problem-seeking missile, right? It's always going to find what the next problem is. That's why they say markets always climb a wall of worry, which then somehow just morphs into this odd pessimism that tends to creep into the market. Well, if you all remember, well over 2 weeks ago when we started having the initial sell-off of the carry trade unwind, I really tried to encourage, not just, this is a lot of times the videos that I cut are just me talking to myself, reminding me of the things that I need to do, that I should do. But on the other side of that, it's also, hey, there's really seldom a reason to panic. I don't think there's ever a reason to panic. It's always a reason to change timeframes and ask yourself where the opportunity is for us on a different time frame. And during that carry unwind, it pushed out to looking at what was going on a weekly chart, and a lot of those wish list numbers picking up mean reversions on weekly time frames. We thought, oh, these will never happen, and then they did. And then if you think about where we are right now in the broader averages, let me bring that over. You think about where we are right now in the broader averages, all of a sudden you say, gosh, it's almost as if, and you kind of think about what we've been talking about in the free videos and here in Charts and Coffee for weeks, right? This wasn't about let's get bearish. This wasn't about, the markets are going to continue to sell off. This was, and now it's proven to be, hey, can we at least take back the ridiculousness of the big dumb money that got caught up in 0.3 of a percentage point increase, right, from the Bank of Japan. And here we are basically going about what we likely would have done anyways, but we had to take all that back, meaning we had to shake off all the panic that was just going to be bombarding us from the media. And then once that sort of subsided, price action made them shut up. Lo and behold, everyone's bullish again. There was never a reason to not be, right? It just may not have been bullish on an intraday time frame for 3 or 4 sessions. It may not have been bullish until we went and tested that anchored VWAP on the daily for a handful of sessions. But if you take a look at the weekly hardly flinched. The uptrend stayed very, very much in place. So please be cautious of any kind of alarmist bearishness. Most of the time, it's going to cost you money. And I don't mean costing you money in terms of a bad trade. I mean, bearish plays were just simply since, as you can see here, since the 5th, since the 7th, just a bad idea. However, it's an opportunity cost, right? Everything isn't just, hey, that trade was a loser, but I stuck to my stop loss, which is great. But then you ask yourself, gosh, by listening to all that bearish junk in here, it cost me what? It cost me looking to the upside. It cost me looking for opportunities to the upside. So that's why I say, remember, bad advice isn't just bad advice. Sometimes it's an opportunity cost. And I try to be really, really measured about what it's going to take for me to say, look, it's really time to commit to the downside. Because a lot of folks say, Rog, you're almost never bearish. Go take a look at a weekly time frame, right? Go take a look at the bigger picture. So sometimes you just need to change your perspective. Look, this is the weekly time frame of the S&P, and that's what I'm hoping to get across with some of these discussions. All right. So with that being said, let's go ahead and take a look at what we've got going on this morning. We'll take a look at the 5-minute chart. We'll take a look at the daily time frame. And I would love to get into some swing trades. I knew that at the end of the OPEX session, I would be flat in all the swings that we had built up until that point of the month. And now I know that this week really is a good opportunity to shorten the time frame and look at some day trades while we get past at least Powell's scheduled speaking engagement on Friday, and then into next week where things should be a little bit better than this week. So is next week going to be as difficult as this? No, I think there's enough scheduled data to re-engage a lot of the volume that's sort of just gone for a walk this week, or sporadically coming in depending on what's on the calendar. All right, that being said, all right, let's jump on over to what's going on intraday. And you'll see, oh, surprise, surprise, we're moving higher. What I love, however, is that we're trading a little bit more clearly above the previous session close. Yesterday, we had a couple of setups. Yesterday, we traded Coke to the long side and the Russell to the long side. So that was the plan yesterday, and I would love to find some more intraday trades like that today. Now, not everything is super bullish, right? Yes, the Nasdaq's finally moving because if you recall, about a week ago, he said, look, healthcare and financials were making it to the top of the leaderboard, if you will, in terms of relative performance. And that benefits the Dow and the S&P, which actually got bullish sooner than the Nasdaq and the Russell. The Russell's lagging because KRE is still having a little bit of difficulty. As you can see, there aren't steady green candles here. It's having a little bit of difficulty finding some traction, but XLK and SMH have been waking up, right? See some green candles there on the daily time frame. And as long as that's happening, the Nasdaq is going to benefit because now the cylinders of that motor called the Nasdaq, those cylinders are firing, as opposed to when we had industrials, financials, healthcare, those cylinders firing. That helps the motor of the Dow and the S&P. So that understanding of the sector weighting is really going to help us in that decision of really kind of in a hierarchy way, or a trade this, not that, whatever resonates, what is more bullish than something else. And I think the other thing to also remember is our staples and utilities, the defensives are still really strong. So let's remember that it's not just about the S&P. It's not just about where's NVIDIA going next, that kind of thing. Sometimes you have to look at names that we haven't looked at in a while. They may not be in popular rotation. A lot of times, in the mastery, we trade unusual names. We were long telephone. We were long Coke. We were long utilities and staples and Newmont mining, playing GDX, right? So if we stay fixed on what's tech going to do next, that's an opportunity cost, right? So I don't want people thinking about costs just in terms of loss. Once you get to a point where you're really managing your loss well, and you've got position sizing down and you understand stop loss and risk to account and risk to target, now you're saying, okay, what's the next level of optimization? Reducing those opportunity costs, right? Okay, and that's all watch list building, by the way. That's all watch list building. As always, gang, if you have any questions, feel free to type them on in. What do we have here? Oh, by the way, yes, I do like to let you all know when we have a sale. We had a bunch of people in the Sector Secrets Mastery say, Rog, we just took advantage of that 30% off sale. to check out the mastery, if that's something you've been wanting to do. Look, any indicator, any course, I won't say any, there are a few exceptions, but they're all listed at the site. But darn near everything else to some degree is on sale. So whatever you save, picking up that indicator you've wanted or that course or that mastery, to me, that just goes into your account. And so I like to mention when things are on sale right now, you can take advantage of that over at the store. Okay, so Jay Moss says, thank you for being one of the few voices to remain bullish in 24. CNBC will never mention the wall of worry, but we've been climbing it for 9 months. Yeah, I think, it's really interesting, Jay Moss. 08, 07, 08, and the just overt and I think misplaced celebration of trades like, and I'm not dissing these people at all, but the way that we celebrated the top pickers, Paulson, Burry, and made it seem that trading is putting on this big play based on some giant macro thesis and then making billions of dollars. Believe me, no one, look, Michael Burry made what, 2 billion? Paulson made what, 20 billion? That's a trade a lot of people don't talk about from 07, 08. But I don't believe most of us can put all the chips in the table, all the chips in the center of the table, just going all in and saying, I'm going to make a big bet. And yet, I think that's what's happening because traders are starting to think, oh, it's really about picking that top and taking advantage of the mean reversion. And, something I've been thinking a lot about, Jay Moss and everyone, is what can we learn? I've been obsessed about this for about 3 or 4 weeks now. What can we learn from the biggest, well, I won't say the biggest, from the most successful hedge fund in history? And that's Renaissance Technologies Medallion Fund. A lot of folks know how secretive a fund it is. We'll never know the details of the strategy, but a lot of details about the tactics, the methodologies, and mindset of that fund have been in the last year or so, 2 years, really much more transparent. And one of the things that I find super interesting is that particular hedge fund approach was a trading approach, not a high frequency trading approach, a short-term time frame approach. A lot of times under 2 days, but usually not more than about 2 to 10 days. So I'm thinking, wow, us traders could learn a lot from that particular fund. How do you use a lot of the tactics? And that's what I've been studying a lot. How do you use a lot of the tactics? How do you find a statistical edge? Those were things that they did and apply it to account growth, right? And so I've been thinking a lot about, if I am Medallion Fund, if I am Rentech, I'm not a math genius, but I know we can all find a statistical edge. We can all find recurring anomalies, as Jim Simons would call it. And how do we use some of what they did to short-term trade, which is really what they did, not high frequency, and start to grow an account? So a lot of that was just, they were agnostic. They were agnostic about what they traded. They were agnostic about the direction in a lot of ways. They just traded what they saw or what the machine saw. I think there's a lot we can learn from that. And so if I don't see, J-Moss, to your point, if I don't see a reason to get overwhelmingly bearish, yeah, I don't want to just kind of flip with the wind. That's going to cost me money. Yeah. So thanks. I appreciate that. All right. Can I review Taiwan Semi? SMH has been a good name, and Taiwan Semi, interestingly enough, is one of the names that I've been talking about. A lot of times I'm going to trade symbols that most folks aren't talking about because, once again, much like the Medallion Fund, I'm agnostic to what it is that I trade as long as it has liquidity. So if we take a look at semiconductors, which have been waking up, agreed. You take a look at semiconductors, there are just a few names that actually make sense in this group right now. And NVIDIA, AVGO, maybe AMD, we'll have to see if it can persist with the green candles, TXN, those are just a handful of the names, and semiconductors themselves. SMH is a very liquid ETF. And if we've got some bullishness in those pockets, it makes a lot of sense. If the candles remain green, that's going to be my preference. Otherwise, what I'll be looking at is, if you take a look at something like Taiwan Semi, was the question? Sure. So Taiwan Semi is bullish enough. It's not a trend. It's not as bullish as a few other names. But if I can get a move to the daily price movement range, I'd be a fan of buying on a pullback. But it may not be necessarily. So again, so much of trading is the hierarchy of what looks better. I think NVIDIA actually looks better. I think semiconductors themselves would actually look better, but I would not be a bear in Taiwan Semi, right? I just don't think the setup is quite there yet for me. Okay. And again, I'm very choosy about setups. I'm not looking to buy at, I don't know, whatever. I'm not looking to buy at, say, 170.20 and take profit at, 170.80. I want to move much more significant than that. So in order to get more significant moves, a better return on my time, a better return on my capital, I'm looking for different statistical edges to get that upside follow through. So any old weakness is not going to be enough, and any old bounce from that. I don't want to take these tiny, tiny, tiny wins. I don't mind it, better than big losses, but I'm really looking for that statistical edge where the upside follow through is so much better. And so, case in point, look at Coke, right? We've been in Coke for weeks, and it's probably starting to garner some attention now. We've been playing Coke for the better part of a month, right? Why? Take a look at the structure, right? Now it's going to be a little challenging for Coke from here on. So latecomers are probably going to have a little bit more challenge. So I'm not looking for a move from 69 to 69.80 or 69.70. What we were looking for were moves like 67 to 69, right? So think about the scale of the move that you can capitalize on. And that's what I mean by statistical edge. And I just don't have that with Taiwan Semi quite yet. All right, Ren, American Express. All right, let's do the same thing. Let's go over here. Let's go take a look at financials. All right. And then in terms of what is bullish right now, Berkshire, JP Morgan, Visa, MasterCard, Goldman, American Express, and Chubb. So I would put definitely American Express on that list, looking purely at the candle color from the top tier pro system. All right. So now what I'm looking at is American Express. This is yesterday's candle. It did tag the daily price movement range, much like it did on the 15th. So what are the setups I'm looking for specifically? And ideally, a green candle in the gray zone. So that would be the 14th, that would be the 15th, and that would have been yesterday. So those are the different opportunities to buy with that higher statistical edge of follow through, right? If I wanted to be really busy, I could probably sling 3, 4, 5 trades a day and look for tiny little gains. But the problem is the disproportionate risk that oftentimes accompanies those tiny gains doesn't make that approach scalable. Again, think like a hedge fund. What's a repeating statistical anomaly with preferably more reward than risk, or what they fancy words call asymmetrical trades, right? And for me, that statistical anomaly works when we pull back to a level where the upside is so much greater. And so I wait for those. And I think American Express could be a decent example of that. But keep in mind the flow, right? Index sector stock, Chris. So Dow should be up, financials, XLF should be up, and American Express will benefit. And by the way, who else did that? Rentec did that. Rentec did that. In fact, the last market they added to the fund, the last type asset class they added were stocks. They were the toughest nut to crack for the models until they didn't look at individual stocks, right? They looked at stocks within the group. And this is straight from the way that they did it. So I'm thinking, again, what can we learn from a billion plus dollar hedge fund, right? I don't remember how many assets, what their asset under management was. It was a lot, but they capped it. They capped it. They didn't want to keep getting bigger and bigger. By the way, that's what hurt John Paulson. He had that huge year, took in, I don't know, $4 billion under management, and it's tough to grow that large an account. We hear the same thing from Buffett and Berkshire Hathaway. At some point, it's difficult to allocate those kinds of funds. But anyway, the last asset class that Rentec added were equities, and the way that they found to make it work was essentially the index sector stock approach that we talk about so much. Yeah. All right. Let's see. Oh, I'm out of time. All right, gang. So as always, if you have any questions, get them in early. Thank you so much for being here. I just kind of get through the symbols one by one. Yeah, NVIDIA is a good one to keep an eye on. XHB, not quite yet, Dave. And XHB itself is usually pretty illiquid, so you'd have to find a stock within the XHB to trade. I like the ITB a little bit better. It's the high concentration weighted version of the home builders, home construction sectors. All right, gang. As always, thank you so much. I'll see you tomorrow, same time, same station. Be good to each other.